Maverick Traders, welcome to the trading room for February 13th through the 17th of 2023. This is Darren Fisher. I'm joined by Mr. Corey Halliday. So let's get started. As always, trading contains risk. Make sure you're sizing yourself properly and making good trades. So first thing we want to get out of the way is fantasy football, another season out of the way. And we just want to say grand champion Keith D, congratulations. You've got a $300 Amazon gift card coming your way. And the league winners are going to get a $50 Amazon gift card. Those are Kurt C, Kit B, Brian H, and Vincent T. So congratulations to everyone. Good job. And let's see what the market's going to do. So last week's news, the markets fell back in price. Okay, the S&P and the NASDAQ, they both pulled back to the prior breakout zone. It's a pretty stark pullback. It's orderly. Nothing has fallen. The wheels have not fallen off of anything right now. It's been a very orderly pullback, but we've essentially given up most of the gains that we had from last week. Last Thursday we had a very good gap up. And the thing about last Friday is we gave back 2/3 of that gap up, and this week we continued that. We're back down to that prior breakout zone. However, the technicals remain bullish. Right, that 20 simple moving average is above the 50, and that's above the 200. So technically, we still have to be bullish. We just have to be a little bit less bullish and look at things in the short term right now. The economy is resilient for now. Consumer sentiment came in at 66.4 versus a 65 expectation right there. The consumer is still driving the economy. It's not as bullish as it has been in past years, but it's above the economists' expectations. So last week, it really wasn't a whole lot of stuff going on. I mean, Fed Chair Powell spoke on Tuesday. That really didn't move a whole lot of stuff. A lot of talking just this week. And the only thing that came out, unemployment claims essentially in line, came out 196,000 versus 191. I mean, that's a rounding error in some of these things. And you can see the consumer sentiment came in right there. Now, the inflation expectations, consumers are expecting inflation to go up to 4.2%, and the previous was 3.9. So people are expecting more inflation in the future. Let's take a look at the markets here. So this last week, the Dow was essentially flat, down negative 0.06%. The S&P was down 1%. The NASDAQ was down 2%. The one that got hurt the most here was the Russell 2000. That was that was down 3.39%. Oil had a great week, up almost 9%, 8.72%, and gold essentially went nowhere. Let's take a look at the charts in close detail right there. So you can see last Thursday we had that nice gap up, and everything looked good. We were talking about that was the breakout, but there was a big question: was it a breakout or a blow off? And you can see Friday's candle said, no, that was pretty much, this is kind of a blow off right there. And we went down. Okay, we've been talking about how we've had this band of what was resistance. Did it turn to support between about the 408 level and the 410 level? I mean, that established itself in December twice, and then also back in September as well. So we were relying on that for support. We're currently just right at the lower end of that right now. Now, what else do we have looking out for us? We've got support also at the 20-period moving average, which we're pretty close to right now. And then we've also got support at the 50. We could go all the way back down to about 395 on the S&P, and we still have to technically be bullish because we're above that 50-period moving average. Anything orderly down to there, it's just a bull pullback right now. If we break decisively below that, then we can say this is the start of, could possibly be the start of a new leg down. But where else do we have support? We've got support at that 390 level as well. We've got support, very good support at that 380 level. I don't see us rocketing down to those levels anytime soon. I think what we called in our year review is 2023 is going to be a very choppy and sideways market, and I think that's what we're beginning to get. Poked our head up above that 410 level. We're back down into this range between 380 and 410, and I think that's what we go back and forth on. And let's take a look at the NASDAQ as well. Same situation right there. The NASDAQ broke higher more decisively than the S&P did, but now we're back down to that same area of support, resistance that became support. Do we go through it again? I mean, that's the big question. We're right there. But again, it's the same thing is the S&P. We've still got support at the 20, and we've still got support at the 50. We can go all the way down to 283, and we'd still have to say we're technically in, we have to technically be bullish. So in the short term, it's okay to be a little bit less bullish, but you can't flip your whole portfolio over to bearish. The technicals just do not support that right now. Corey, what's your take on the market?
Yeah, I would agree with you, Darren. The exhaustion high here was kind of an exclamation point at the end of this move. It was a big rally, and we talked about how bearish the markets got in December, loading up on puts for the January and February time period. And now we've kind of run upward, causing all those puts max pain, causing them to expire worthless. We broke above a downtrend line that was in here and so on. And it was kind of a max frustration move to move upward to all of those bearish traders and that positioning and so forth. So now where do we go from here? My take is pretty much choppy price action in the near term. I think my outlook for this year was kind of a strong start, and then we'd get this middling, choppy, kind of grinding price action back and forth. And I think that's what we just entered into last Thursday. A week ago yesterday is really that exhaustion point. So now it should get choppy for a time, and then fast forward a few months, and my expectation would be that we're actually back down and testing some of these lower levels. I think the markets are going to have to deal with for the next couple of years this big transition from quantitative easing to quantitative tightening. The markets are going to have to get accustomed to higher interest rates. That's going to be more expensive for consumers. That's going to be more expensive for corporations. So it's just a long, drawn out process. So hopefully you're kind of embracing the chop. You're figuring out how to fade some of these reactions and so forth. And that's probably the name of the game for a while. The VIX is kind of interesting here. We call it the fear gauge because ultimately it measures how much options cost, and specifically put options on the SPX index. And when you think about puts, that is protection. So big institutions, if you think about the two most common option strategies out there, are to sell calls and to buy puts. So buying puts is one of the most common strategies. Again, selling calls and buying puts, those are the two most common things done. And that's because institutions do this against their longs and they do this against their long stock positions. And so they really loaded up in December, but that put protection goes away this week. We're entering into options expiration Friday, this coming Friday, February 17th. And those a lot of that insurance that was bought will go away. So that does leave the market a little more susceptible to downside potentially, just being less hedged, less protected. The VIX has started to move up. It tends to move inverse to equities, of course. So as stocks go up, the VIX goes down. Well, stocks went down this week. The VIX went up. But notice nothing huge that really turned this around. It kind of even fell off of the highs there, kind of left a long upper shadow, and that oftentimes is a little bit of a bearish point for the VIX. In fact, one of my favorite approaches is when the VIX is really blown out and it gets to a crazy high number and then it just goes vertical. You'll often see this massive, massive shooting star-like candle, a huge upward wick. So these upward wicks are really a good spot to be bearish on the VIX. So if you believe the VIX and you believe this signal on Friday, it's suggesting that it's going to back and fill next week, which would mean what? Well, if the VIX is moving down, if you believe it, if you trust it, then the S&P should be bouncing back. So this initially for next week is a dip to be bought. I don't know that it goes much higher, but that's kind of what the VIX is suggesting in the short term is, hey, we're back. We should roll over here for a few days. The market should rally for a few days. And certainly the CPI is going to have something to say about that. So this week, I really think it's all about the CPI report. What's interesting is if you look at the data of the last 6 or 7 CPI reports, I think the stock market has moved on average about 1.5 just shy of 2%. Now, those are big stock market moves. If you go back to the prior years, nobody even paid attention to the CPI. The CPI would come out, who cares? It went from 0.1 to 0.2. Interest rates and inflation and all of those things were near zero bound. And for the longest time, the inflation in the US, well, we were battling deflation, right? Inflation was the furthest thing from our minds. It was not a concern, it was not a risk. Having said that, the markets have changed dramatically, and the Fed just made an enormous error when the CPI started to really spike. And it's so obvious. I don't know. I mean, it's in every textbook. The Fed should have been well aware, but for them to say, oh, this is just transitory and it's going to go back when it started to spike and they kept pumping liquidity into the system and so on, it was just a huge policy mistake. So the CPI is expected to come down from 6.5 to 6.2% annualized year over year inflation. So the expectation is that we'll hit 6.2. Now notice the monthly inflation is expected to come in at 0.5. Last report, it was actually negative. This report, it's expected to tick back up a little bit. So why would the year over year number fall if we have 0.5? Well, because the number you're getting rid of from the yearly calculation is even higher than 0.5, right? If the number you're getting rid of is 0.8% from 12 months ago, and you're adding a 0.5, the year over year inflation will come down accordingly. My expectation, my thesis is that it was much easier, and we could see inflation was rolling over last fall, far back as Thanksgiving and so on. Inflation had started to tick down. Remember, the Fed's target is 2%. We had inflation up at like 8-9%. My theory, my thesis personally, is that it's so much easier to go from 9 to 6 or 5. It's a lot harder to go from 6 down to 2. This drop is pretty easy. This drop is pretty difficult. We went from 9 down to 8, 7, 6. That's been easy, kind of even getting a little lower. If you look at the yearly inflation numbers, there's a couple of reports. If you went and looked at a graph, there was a 1.1% month over month inflation number. There's another one that's at 1. There might even be one that's at 1.4, 1.3. I don't remember exactly. But anyway, those are coming up. So we're going to get rid of a couple of really high inflation numbers from this year over year. So this going to 5 or so, again, that's the easy part. Getting from 9 or 8 to 5-ish, easy. Getting from 6 or 5 inflation down to 2, now it's tough. And that's where the markets, I think, have some trouble. So that's a story for a couple of months from now, probably. But that's where the markets could really start to have some turmoil. If you think about what the market is pricing in and how, in my opinion, they're wrong, the market is pricing in interest rate cuts later this year from the Fed. The only way the Fed is doing that is if inflation has come down dramatically and if they've gotten it down towards that 2% number. If inflation is still at 5%, they're not going to start cutting rates and so on. And again, that's where it gets difficult. Imagine that inflation's still at 4%. It's twice the Fed's target. Are they going to be slashing interest rates? Probably not, even if an economy has kind of stumbled. And so that's where you get in this slower economy and you still have this sticky higher level inflation than they want. That's, again, a story not so much for this week, but probably coming in the not too distant future this year. So February monthly options expiration, we talked about this huge put to call ratio spike in December. Remember, they trade the front 2 months. That's where all the action is. January puts have already expired. The Febs are set to do the same this Friday, and then the market is left less hedged, less protected overall, more vulnerable to the downside. And certainly You always want to pay attention to options expiration. There can be some volatility around that. I believe it might be a quadruple witching this Friday. So some good stuff to pay attention to there this week. So other than the CPI on Tuesday, which again, I'd expect the market to move 1.5% or something on that announcement, so be prepared. Retail sales on Wednesday out of the U.S., both core and regular. Core PPI and PPI numbers on Thursday. So last week, it was all about Fed speakers, like Darren said. This week, we actually get some real data and some real things to pay attention to.
Yeah, Corey, I think we're at a zero for the week. And I mean, you look at the markets, look at our monthly. We've downgraded our monthly from a +3 to a +2. Now how can we do that? We're above the 20, we're above the 50, the 20/50 slope looks good. Why shouldn't that be a +3? The only reason I downgraded it to a +2 is because we are in that pullback. By no means am I bearish right now, but I'm just less bullish until we bottom in the pullback, get a confirmation candle, stay above that 20. And once we go back up, I'm happy to just call it, hey, bull pullback. And now we can be at, back to a +3. I just want to see where we bottom here and watch for that confirmation candle and see what we do. And this is a year when a +3 doesn't necessarily mean +3. It's going to be a choppy year, I think. So we're just going to have to wait and see how that pans out. So this is definitely an interesting year to trade. So let's take a look at some of the sectors right now. So you can see, despite all the downward movement we had, you look at that histogram right there, the only two movers I would say would be communication services down 5.6% to the downside, and energy was up almost 5% right there. I mean, that had a lot to do with the price of oil being up almost 9% right there. Everything else was down. I mean, except for energy, it was all down. But look how little down it was. Utilities down 1/3%. Healthcare down 0.17. Financials down 1/4%. And those are not really, newsworthy moves right there. I mean, you've got a couple of -2 moves in real estate, consumer, and materials, but everything else was very, very sedate. So looking at the sectors individually here. Now we've got utilities here, and utilities I had at a -1, but I'm looking at how much more downward we're going. We're getting further away from that down-sloping 20-period moving average. So I'm at a -2 on utilities right now. That's down from a -1 last week. So it looks like utilities are just taking a little bit of a turn. Communication services was at a +3. We're sitting right there at the 20-period moving average. I'm at a +2. Again, I want to see a confirmation candle. I want to see that bottom, and then I'm happy to get more bullish on communication services. But you can see Wednesday, Thursday, and Friday were pretty ugly days for communication services. Real estate, I was at a +2. I'm now at a +1. We're just moderating a lot of stuff right now based on the performance. We're sitting right there at the 20-period moving average in real estate. This is also a nice band of support that we established back in December and again in early January. So if we can bounce, I'm happy to get more bullish. Like I said, I'm still bullish. I'm just not as bullish on a lot of stuff in real estate right now. Industrials, at a +1 on industrials. That's not changed for the past couple of weeks. Just mildly bullish. I mean, you can see we're sitting in this kind of sideways band between about that 98 and the 102 level right there. We've just been going sideways really since the I would say mid-November. We've just been in this band. So if we can break out of this band, I think we have a nice run in industrials. But until we can break out of it, I just don't see it. So down here to healthcare, at a -1 in healthcare. This is kind of been mirroring what utilities have been doing, except utilities broke a little bit further to downside. We're just slowly bouncing off the bottom of that 20-period moving average. No massive selling. It's just I think people are taking the gains that they've made in the past couple of years in healthcare and finding other places to put them. I think it's more profit taking than anything else. I don't think the fundamental outlook for healthcare is not bad. You can see it's just in a slow deflating balloon as money goes out of healthcare. Financials, again, we're sitting right there at the 20 period moving average. I'm at a +1 on financials. Bullish, but not extremely bullish. It doesn't look like it did, between October and December. This is just, I think we're more sideways to up than we are anything else. Consumer, this one I've moderated. We were at a +2 for a few weeks before. I'm not a +1. Again, just wait and see where this bottoms. There's some good names out there that are still making gains. We just want to see when we come back in. This is another one. You've got a huge amount of support about that 146 level. And you can see that's been support since October, into November, into December. Which coincides just about with that 20 period moving average. I think there's going to be a lot of support right at that level right there. And again, I'm at +2. Despite what the NASDAQ did, technology did pretty well. It held up very good. You can see Wednesday and Thursday were red candles, but we still held that 140 level in the entire sector, which you can see. We established support right there in December. And again, that was the jumping off point 2 weeks ago when we broke above. So this is going to be, we're right at support right now. It's held in nicely. I'm still at a +2. Now, materials took a pretty good hit. You can see, we were above that 20 period moving average. We moved all the way down to that 50 period moving average right now. So right now, in between those two ranges, I'm going to say we're at 0 for materials right now. And we're kind of at the same thing in energy. Energy had a great week, but we still just barely broke above that 50 period moving average and that 20 period moving average. Give me another couple of candles and I'll be happy to do that. We were at a -1 last week. We're at a 0 for energy this week. So you can see as we stack everything together, the weakest utilities at a -2, healthcare at a -1, energy materials at a 0. We got 4 sectors: consumer, financials, real estate, and industrials at a +1. And the best looking sectors right now are communication services and technology. So let's take a look at a couple of trades. Last week we wanted to be short CMS, and it was down 2.1%. So that was if you got into the trade, that was looking pretty good. This week we're looking at WTRG, essential utilities. It's kind of in a low base right there. It broke below that be the 46 mark right there, and so we're not expecting a whole lot. We got a 1 week trade here. We're just going to say, 45, 46 bear call for a week. It's going to have some positive theta to it. If the markets go sideways, you make a little money. If WTRG goes down, you make a little money as well. We're not going to get over our skis on anything with 1 week till expiration, and especially we don't think the market's going to make any very large moves. And communication services. Last week we were long Netflix. Netflix was looking good up until Friday. It ended the week down 5%. We've got another week on this where it's still technically in a high base, I would say. So this is looking pretty good. If you had your profit target on, that 370 level, you may have hit it on Thursday and run the register if you did a good job. If you're not, I think we got another week on this, and just wait and see where it goes. And this has been a pretty strong stock here, despite the action on Thursday and Friday. We're looking at this week is Spotify, nice high tight base right there. And so what are we going to do? I can't believe it. I'm saying we're out to March. Okay, so one thing you can do is that last week of options expiration, you can have essentially a 5-week trade if you want and reevaluate. So I would say go long the March 120s and short this next Friday's 125s. The only thing you're asking it to do is just hang out right where it is. You're not asking it to move up. You've got a little bit of downside protection if it moves down, but just hang out there at 125 for a week and then make your decision where to keep those March calls. And healthcare. Last week we were short AbbVie, and that was looking like a really good trade up until Thursday. And even on Thursday, you could be forgiven for wanting to get back in the trade right then. You see a long upper shadow on Thursday, but it caught a good bid on Friday right there. So you've got a little bit of time on this one. You're probably sitting at a small loss on it. That's fine. We've got a ton of other trades to do throughout the whole year. Right now we're looking at Amgen. This is just in a nice downtrend. We might be getting the start of a bear rally looking at Friday's candle right there. If we, take a look at Monday, if we've got another update Monday, just put this one to the side and wait for it to roll back over. But if it does trigger on Monday, I would say that February 240, 245 bear call, this is going to be another one where you're right in between those two strikes. You got a little bit of theta working for you. You got a little bit of delta working for you. And you can afford to have this trade go sideways or down, and you're going to be looking pretty good. So this is the kind of trades that I'm looking at, very short term, very defined reward, defined risk, not asking a whole lot of anything in a 1 week period. And industrials, last week we long GXO, and again, this is another one that was looking pretty good up until Wednesday right now. So this is down 4.16%. I've got a little bit of time on this trade. Technically, again, it's still in that nice high, it's in that nice high base. It's been in that range between 50 and 56 for about a month right now. This looks to be strong. If you got into it, give it some time. If you haven't got into it yet, wait to see what happens on Monday and Tuesday. And if Friday's candle was the actual bottom, that's going to be a great entry point for this if you want to get into it. Right now, we're looking at AQWA, that's Evoqua Water Technologies. This is a great thing about using the screener. I don't think I've ever heard of this company before, but I was just looking at performance right there. So again, we're not asking a whole lot. We're looking at, what I would say, we don't use horizontal calls very often. We're in this base, but we don't expect it to move very much. So I would say go long the March 50s and short the February 50s against it. You've got a pretty good profit area right there. If you look at the risk graph, it looks like a fairly wide tent. And that's gonna be looking good. You're just asking to stay where it is within $1 or $2 for the next week, and that's good. If you're a little more bullish, you go out to the March 47.50s and then short this Friday's 50s against it. So you got a $2.50 diagonal call spread right there. If you think it's going to break out, that's the one to do. Either one of those trades, I'd be happy. And financials, last week we were, looks like long Capital One Financial. And again, we're still in this nice high base. This is one of those ones that was a high flyer. It just gave up a little bit, held in a lot better than a lot of other things. So this is sitting right at support. Thinking there's another week or two on this trade. See if it catches a bid Monday, Tuesday, and then reevaluate from there. Right now, this week we're looking at OMF. That's One Main Holdings, nice high base. I would wait for a, you can say we're in the beginnings of a bull pullback. We had a really good day on Tuesday. If you want to see what it does Monday and Tuesday this next week, completely good. This is another one. Looking at a 45 March, February horizontal call. Once you get a confirmation candle, you could even go long the March 42.50s and short the February 45s, just a little 5-day trade right there, and for a diagonal call. Corey, why don't you take us through the rest?
All right, so consumer stocks. Last week we highlighted a bullish position in Tesla. This thing has been on an absolute tear. It was up again this week, 3.64%, even with Friday's decline of 5%. So that right there tells you it was up 8% on Thursday. So big runner. This week, Abercrombie, A&F, you could do a diagonal call spread or a bull call spread. Either way, kind of targeting a little bit of an upward push towards 31, 32 per share, depending on how bullish you are. The more conservative targets, 31, doing the diagonal. If you're more bullish, go with the bull call spread. Now, that bull call spread, because it's such short-term positioning and you need that push to 32, you should have a much better than 1-to-1 reward to risk ratio. It's probably pretty close to 2-to-1 in the reward to risk ratio on that bull call spread. Here you can see the upside move, and it just continues to chug along. Technology stocks, last week we highlighted AI as a potential long, and this stock fell to the downside. There's a lot of volatility in these names. Google's being hit by the AI story. They had a big event this week where they screwed it up. If you haven't used ChatGPT and some of those services, it's pretty amazing what they can do. But AI, it's been on a tremendous run to the upside. You can see really early in the week, it put in its high and gave you a sign that it was exhausted to the upside. So it spent the rest of the week, Tuesday, Wednesday, Thursday, and into Friday, coming back down, but definitely spiked up there and kind of exhausted itself. RPD as a potential bullish trade, again, not super high target here. March positioning, you could target 52.50 through February, kind of test the trade a little bit, and then see if you want to continue to hold the diagonal into March, or just position for March and do a targeted butterfly up towards 55 or thereabouts. So RPD as a bullish idea. Um, Next on the list, materials. So Cliffs we highlighted as a bullish position. This one was down 7%, and it just really never had it all week. It gapped down on Monday, sold off a little harder, kind of came down towards basically filling this gap. So kind of still in that bullish category. You wouldn't really look at this chart and say it's bearish, but it's not holding up quite as well as maybe it could have, would have, should have. So you might get in that type of consolidation, just that choppy kind of range bound trading that's playing out quite a bit. Still dynamics is a possible long. You can see here again, pullback, but this one holding up a little bit better than the stock we just looked at, right? It's holding up a little bit stronger. It hasn't broken below its 20-day moving average and so on, so some signs of relative strength. You could do a February call butterfly targeting a bit of an upside move this week, or maybe even do a March Feb diagonal call spread. Either one of those, we're targeting 125, so very mild bullish outlook for this week. Energy. So EQT we highlighted, and this one reversed. Energy stocks in general reversed at the end of the week. As we looked at it, for the week, only energy, was the only sector that was up. And guess what? Energy pretty much made all of its gains the very end of the week. So that's really where two paths diverged. Energy started to go up, and the rest of the market really started to get hit. So as you look at EQT, we were looking at it on the short side. It kind of dropped as expected the first part of the week, and then popped back up by the end of the week. So a little more strength in this sector. Again, we've got to give some consideration to that. It's certainly reversed. There was certainly some rotation. It probably has more to play out. Oxy on the bullish side, and this is one of my preferred ideas in energy. I highlighted this one in the market roundup on Tuesday, so I'm glad they have this in here as well. You can't see it as well, but if you go back multiple months, there's a trend line that it's hit like 6-7 times, and it hit it again this week. So right on top of that trend line, and then started to burst to the upside. I think, again, this one's reasonable for kind of bullish to sideways movement. It really kind of depends upon your energy outlook. I think we'll probably, like a lot of things, chop around here for a time. Depending on how long it takes, I do think we end up breaking out to the upside. But for the next couple of weeks, you can see the indecision. Look at how the moving averages are turned sideways and crisscrossing. The 20 and the 50, just indecisive. So we're not out of the sideways range yet. You'd really have to start breaking above this level and so on. And I'm just not so sure it has that type of momentum and gas. It's going to depend on the energy sector. Again, if oil spikes and starts to take off to the upside, then this can be better than a sideways trade. But right now, it still looks like it's just going to kind of be stuck in a range at least for the next couple of weeks. Darren, want to take us through the conclusion?
Yeah, thanks, Corey. So right now, despite what you might think the market is doing, we just have to say we're in a pullback, and we're in a pullback until proven otherwise. Remember, we go all the way down to the 50-period moving average, and that would still be bullish for us. So have your portfolio be slightly bullish depending on how you allocate. And this is one of those times, we said this last week, portfolio allocation is going to be key in this. When you first start to make your trading plan, you decided that whatever your market outlook was, you're going to allocate X number of positions in what, whether it be bullish, bearish, or sideways. It's time to stick to that portfolio allocation. Go long and strong. You don't want to be looking at any value traps, and you also want to short the weak. Don't try to short something that's strong just because you think it's overpriced. All right. So we've got going this week. We've got our market roundup on Monday, and then on Tuesday we've got using TradingView as a simulator. Okay. There's a bunch of different simulators out there. Sometimes we don't have one ourselves. Sometimes the ones that we recommend, they just go offline for whatever reason. So TradingView, very, very reliable. We were talking about using that. How do you use that as a simulator in your simulator trades? What's the way that you go through that? What are the procedures? I think it's going to be a good refresher class for a lot of people. Pretty light week the next week, though. And if you have some trades you want to share, please log in and go to the forum and post trades. We always like to see what our traders are looking at, and it's good to share ideas with everyone. So thanks a lot for joining, everyone. Have a great day.